Good morning or afternoon or evening, depending where you are listening from, and welcome to today's uranium webinar. We're very excited that you're joining us today. I'm very excited to be hosting this webinar. Uranium has obviously been a pretty exciting space for the last month. I think there's a lot of things that have been going on over the last 5 years and in the last month that deserve a closer look and that have raised a lot of questions. And so I have tried to answer some of those questions myself. But more importantly, I have assembled a group of people who are very experienced in the uranium space and who can help me answer those questions as well. So I'm going to give a talk, then we're going to get a talk from John Campaglia of the Sprott Physical Uranium Trust so that we can get a bit of insight into its operations. Obviously, it's an important force right now. And then I have 3 uranium companies with very different business plans led by people who are experts in the uranium space. So we will have Phil Williams of Consolidated Uranium, we will have Scott Melby of Uranium Royalty, and we will have Jim Patterson of Valor all presenting their opportunities, and then all of us available to take questions from you. So that's how it's going to work. And without further ado, I'd love to just head into my presentation. So uranium, here we go. There we go. I want to start with looking back before we focus in on what's happened recently. And it's important to look back because what's happened recently has only been possible because of the changes that happened in the preceding 5 years. So back in 2016, what's really cool, I think, is that uranium producers collectively decided to address the oversupply in their market in order to turn things around. They knew it wasn't going to get better unless they stopped producing so many pounds. The result of having all of that oversupply was that the spot price was way below the cost of production, and in time the higher priced long-term contracts that were supporting producers were obviously going to run out, and it was all happening because the spot market was flooded. So as a group, the uranium market closed mines, they reduced output at operating mines, and they sequestered pounds of uranium. This chart shows that, and the result was that from back in 2016 until now, output fell by about a third, from 190 pounds to about 130 million pounds. That's a really significant difference, right? And the price definitely responded, but it also didn't. So this chart goes back to 2012. You can see how the spot price was performing before that turnaround effort. Once the turnaround effort started, production cuts and sequestering supported the price, but also it was a slow slog, right? Then COVID hit out of the blue, and the suspension of Cigar Lake and the additional supply cuts from Kazakhstan really spiked the price. And then, of course, Cigar restarted, and yet utilities, despite this price strengthening, still were not contracting, so we were sideways, continuing to slog on and on. And then we get to this summer. Back in April, Sprott took over Uranium Participation, which was a physical uranium vehicle, but its rules limited what it could do, how active it could be, how big it could be. So it was a very small version of a physical uranium trust. So Sprott took it over and created what we now all affectionately call SPUT, the Sprott Physical Uranium Trust. And it takes a while for these things to happen, but by the middle of August, they got the AOK from regulators to launch their $300 million at-the-market financing. There was a lot of demand for that financing. In about 3.5 weeks, they raised most of that money, $245 million, and they put it all into buying physical uranium because that is what SPUT does. John will speak to that in more detail after I'm done. And that in itself had a huge impact on the price of uranium. We'll see that in the next slide. And by September 10th, SPUT upsized its at-the-market financing, so its rolling ability to raise money, to $1.3 billion. So SPUT has now purchased roughly 10 million pounds, a bit more than 10 million pounds in the last month. It will put all of the money, essentially, that it raises from the market into buying physical uranium and sequestering it. Now, Sprott is not the first to stockpile uranium as a bet on, and to be honest, as a way to help create a stronger uranium market, but it is by far the largest. Now, I originally made this presentation 2 weeks ago, and so these charts were more equi-sized, and then I had to shove the financing chart to the side and just draw in the rest. Sprott has not raised money consistently the way that my green line suggests, but Sprott has now raised about $400 million in the market and put that into purchases of physical uranium, and you can see the pretty direct correlation with the spot price, which is below. And of course, what's important is that $400 million raised still leaves them with close to $900 million of undeployed financing capacity. Okay, so is this just a momentary blip? When they stop throwing money in the market, is it all going to fall back again? Well, I certainly wouldn't be excited about uranium if I thought that that was the case, and so I don't. And the reason is that the fundamentals for uranium are very bullish. So demand continues to grow. I'm going to show a short slide on that in a moment, and it will continue to outstrip primary supply. Secondary supplies have filled the gap because demand usually has outstripped supply for some time, but those secondary supplies are now being dried up from sequestering, and because utilities are buying in the spot market, including Cameco, which has to buy in the spot market to fill its own contracts because of the production cuts that it initiated. And the bottom line of all of this is that new production is unlikely to come online unless prices are higher, because guess what? It isn't a good business plan to produce uranium when it costs more to make it than you can earn by selling it. So producers are going to demand higher prices before they bother producing more pounds. The little arrows across the bottom just show this year we have about a 62 million pound gap between supply and demand. If you add up the gaps through 2025, we're over 200 million pounds. If you stretch it out to 2028, we're up to 334 million pounds. There is clearly a deficit. That deficit, I mean, isn't going away because nuclear is rising. We had a setback, if you want to call it that, around the time of Fukushima, when Japan obviously closed its reactors and Germany and France decided that they wanted to move towards shutting down nuclear. That is not the current sense in the uranium market, in the nuclear market. If anything, demand is rising because it's increasingly recognized as key to the green effort of tomorrow. So governments around the world really are backing nuclear energy. These are just some of the examples of recent moves in that arena. China recently in its, are we in its 14th five-year plan? I think that's where we are now, committed to a 40% expansion in its nuclear fleet in the next few years. Like that's a very significant number from the country that is already the biggest driver of nuclear or of uranium growth. America rejoined the Paris Accord. That was significant. They boosted incentives for clean energy in their jobs plan, and there was a bunch of specific money there for uranium or for nuclear utilities. And then the EU is now including nuclear energy in its sustainability approach, which is likely to stop or at least slow France and Germany's plans to retire nuclear. So that's like the demand backdrop. Directly related to that demand backdrop is the fact that utilities are very short on long-term contracts, right? So utilities need uranium, right? The bottom line here is that you can't turn off a nuclear reactor for a short period of time. You can do that with a natural gas reactor or a coal-fired power plant. You can just turn it off. If pricing doesn't make sense, you can just turn it off and then turn it on again when pricing does make sense. That is not an option with nuclear reactors. That's not how they work. So utilities need to secure the uranium to fuel their reactors. The game from those who are trying to get uranium back to a market that makes sense, where prices support production, is that you got to empty the spot market, because utilities, instead of contracting, have been buying in the spot market. If you can empty the spot market or make it clear that the spot market will no longer be a reliable place for you to secure pounds of uranium, then you force utilities to start contracting. And let me tell you, utilities have historically really acted like lemmings. Once one of them starts contracting, they all rush. The chart on the right here, the one in blue, shows historic long-term contracting, and you can see how many contracts were signed during the last uranium bull market. Which, does that make business sense? No, that doesn't make a lot of business sense, but that's how it works. When the shortage is right up in their faces, and they get scared that they are going to be the reactor that's left without fuel, utilities start contracting. And contracting is important because producers aren't going to sign contracts that leave them in a position of losing money for the next 10 years. They are going to demand very strong prices in those contracts, and that is going to change the game, right? Like, we're seeing the game change in the spot market. When we see the game change in the contract market, that is sustainable because that price lasts. These are called long-term contracts for a reason. Okay, that's the whole backdrop. Where are we going from here? Well, let's just take a look at what uranium has done historically in bull markets. I like to say that uranium bull markets put gold bull markets to shame, right? We all love to get excited about what gold can do when it runs. Well, uranium can do a heck of a lot more. Like I say, utilities have to secure it, so they pile in. That drives the price up. Speculators have seen this play out before, so they pile in. It adds to the pressure, and it's just a small market. It's like having a tight share structure on an issuer. If you don't have a lot of stuff out there, shares out there that you can buy, the leverage is very significant. So you can see the last markets really gave huge upside, and we are just getting started give relative to those past patterns. That's what happens to the uranium spot price. What can happen to uranium equities is even more dramatic. And it's not a question of leverage. In the mining space, we like to talk about leverage. When the price of gold rises, you assume that a miner's cost of operations stays reasonably consistent. And so every dollar that's added onto the price of gold is direct profit for the operator, and that's what the leverage is, right? That actually isn't what happens in uranium. The reason that uranium equities go crazy in a uranium spot market is just because there's hardly any of them. When investors decide that they want exposure to uranium, there are literally a few dozen stocks that they can buy in the world. Like, it's a very, very small market, so it all gets shoved into those few stocks, and that creates incredible upside in uranium stocks in a bull market. One thing that I want to note that I think is an interesting additional factor today that was not in play in previous bull markets is that in the past, passive funds had no way to play uranium. The uranium participation wasn't a great proxy for the price of uranium, and more importantly, it lacked liquidity, and miners had their own issues. They were debt laden at the time, they were very political, so it was difficult for passive funds to find a way into this space. But now those opportunities exist. I would say that the Sprott Physical Uranium Trust provides a platform for passive funds. And that matters because passive funds today, of course, exceed the capital managed by active funds. So you really are bringing a huge load of capital into the space to play that hasn't previously been able to. And so at the end of the day, computers and algorithms that manage passive money can play this market this time too. I don't know what that's going to do, but I think it's a factor that is worth considering. Okay, so are we just getting started? I mean, this is a chart that includes the last peak of the uranium spot price. I'm not going to say where the uranium spot price is going to end up. I know that just yesterday, Canaccord said that they expect uranium to reach $80 a pound before the end of the year. The simplified scenario that I describe here just uses that. It says Sprott has bought just over 2 million pounds a week in the last month. If we assume a little bit less than that, 1.5 million pounds a week until they deploy the rest of their cash, and we assume that the spot price reacts similarly as that cash is deployed, that very simplified scenario puts the spot price at $80 a pound before the end of the year. There's a lot of assumptions in there. That's very simplified. It doesn't include a bunch of things that could happen to the upside and to the downside, but I think it's still a scenario that's worth playing out in your mind. I do think there will be setbacks. I mean, the spot price is off a bit yesterday and today because it gained 64% in a month. So, every 2 steps forward takes a bit of a step back, but I really do think that there is a lot more upside ahead. that's where I'm going to stop, because I have a bunch of other uranium experts on this webinar, and I certainly want to give them an opportunity to explain their insights and opportunities. So with that, I'd like to ask John Champaglia of the Sprott Physical Uranium Trust and the three CEOs from our issuers to turn on their cameras so we can all see your lovely faces. We have with us Scott Melby, who is with Uranium Royalty. We have Phil Williams, who is with Consolidated Uranium, and we have Jim Paterson, who is with Valor. To start, John, I would love to give you the opportunity to take us through the basics of SPUT. Do you love that acronym?
I love the acronym. It's easy to remember, and I also love all the memes that Twitter has created about me. My kids, particularly my wife, make constant fun of me. So it's been a fun time so far.
Fantastic. So I think that your presentation should show up here in a moment. And John, please take it away. There we go.
Okay. Thank you for having me, and thanks for everybody for participating in today's event. We've had incredible interest in the new Sprott Uranium Trust over the last couple of months, and I've been incredibly busy trying to talk to the marketplace about how the trust works. I think it's very important in everything that we do that education is where it all starts, and I think Gwen is a great testament to that in terms of helping people understand and building their financial literacy. So I'm going to try to attempt to educate you about the new trust and tell you a little bit about how it's impacting the market. Okay, for those that are not familiar with Sprott, I'll give you a very quick overview. So Sprott is based in Toronto, but has offices sprinkled around the world. We have about 150 people at the company. We manage about 19 billion US dollars, and we're also publicly listed on both the Toronto and New York Stock Exchanges, which for a small boutique manager, I think is very unique. And it gives our investors an incredible amount of transparency into the company and our financial results, and obviously the governance related to being a public company is very high. You probably know us best for precious metals, and this is our suite of physical commodity trusts on the screen. These funds go back to 2010, and they're about $14 billion in assets. So our gold and silver trusts are the most popular. There are about 250,000 investors in these funds, so they have incredible reach. Most 4 out of the 5 funds trade on the New York Stock Exchange and the Toronto Stock Exchange. And the newest edition, the Uranium Trust, is right now trading on the Toronto Stock Exchange and over the counter in the US. Why these funds are unique is that they only hold physical metals. There's no paper, there's no unallocated forms of metal. They own physical. It's a lot of work to buy this stuff and put it inside of our vaults at the Royal Canadian Mint. But investors are attracted to these vehicles because they are 100% backed by physical. The Uranium Trust is no different. It's 100% backed by physical in 2 different forms, which I'll get into in a minute. Okay, so let's talk a little bit about SPUT. And as Gwen mentioned, it was reorganized from Uranium Participation Corp, which was a TSX listed company that's been around since 2005. And let me just say that this is not Sprott just thinking in the last couple of months, hey, this uranium thing looks interesting, let's create a financial product and try to ride the wave here. We've been working on this initiative, believe it or not, since 2017. It's been a long road. At that point in time, we just thought the uranium market was completely broken in terms of its pricing structure. And we thought that all of the knowledge that we've gained in our precious metals trust, a lot of it could be applied to the uranium market. So we went down the path of trying to create our own fund and concluded that trying to do that at the depths of a bear market would be very difficult to scale. And then we pivoted and tried to pursue Uranium Participation Corp, which took a couple of years. It was a long drawn out affair, but I'm happy to say that we finally got it over the line. We reorganized the company into a trust. That was just in mid-July. And so we've been trading for about 2 months on the TSX, and the reception we've received thus far has been fantastic. So why did we do it? We just thought that there was a real opportunity in uranium in terms of its fundamentals, but we also thought there was a real opportunity to enhance what UPC was already doing in the marketplace. And we went about this in a number of ways. First of all, we turned the company into a trust. And that's important because exchange traded funds are the most popular investment vehicle for almost every investor type in the world today. There's over $8 trillion of capital invested in this, and it really is the product of choice. So that is thing one. Second thing we did was we increased the transparency and disclosure, providing a daily net asset value. And this is really important to provide investors with information to understand exactly what they own, what the trust owns, how we're growing the trust, how many pounds it owns, what's the cash position. And prior to Sprott, UPC was doing this once a month. And there's nothing wrong with that, but I think more information in an opaque market is better. And it helps the liquidity of the fund, it helps price discovery, it helps people understand what the fund should be trading at relative to its underlying assets. The second thing we did was we implemented this thing called an at-the-market offering. And it's really just a capital raising mechanism that you can apply to the regulator to do in both Canada and the US, and we're doing it right now just in Canada. And it really is an efficient way to provide a real-time daily mechanism to raise new capital from investors and then put that money to work and by buying more uranium. So we've done that, as Gwen mentioned, started that on August 17th. And the demand we saw in that initial prospectus that we filed for 300 million was overwhelming, and ran through that capacity in just a few weeks and decided to reload the prospectus with an additional $1 billion, which really reflects the demand capacity that we think is in the market over the next couple of years. And that demand capacity is coming from just about everywhere you can imagine. My wife's not too happy with all the 7 p.m. calls to Australia and Singapore, but the reality is that it is a global category. There are investors around the world interested in this category, and it's not just institutions, it's family offices, it's brokers and RIAs in the US, and it's a lot of individual investors. So we're seeing a lot of interest from every investor type and right around the world. The last part of the reorganization plan is to pursue a US listing, and we will be starting that work very, very soon. And a lot of people ask us, well, when is this going to happen? When will it start to trade on the New York Stock Exchange? The answer is we don't know. And we don't know because we haven't started the filing process. And until you start the process and start getting comments from the SEC, you really don't know what they're going to anchor on. And second of all, it will be considered a novel listing. And what that basically means is it's never been done before. So whenever there's a novel listing, regulators take their time, they ask a lot of questions, and that's really to ensure that the vehicle is shareholder friendly for investors. Okay, so some of the key benefits I would highlight. I talked about it being an investment fund. It's now the world's largest physical uranium investment fund in the world. That's important, not because we want to be the biggest for stature, but it's important because size attracts more institutional investors to the category, and it also provides more liquidity for investors. And when we acquired UPC, its assets were approximately $600 million US. We're now over $1.4 billion in assets. So in a very short period of time between market appreciation and capital inflows, the trust is really bulked up. And why that's important is because when we have a conversation with, let's say, a state pension plan, which I'll give you a real world example we're having right now, and they say to us, hey, we'd like to put $50 million in the trust. They want to feel confident that there is scale and liquidity for their investment to kind of come into the trust and come out of the trust when they opt to do that. I mentioned earlier about all of our experience with physical commodity funds. That's very important. We also have a very valuable technical advisor that helps us with the day-to-day management of the fund called WMC Energy, which Scott knows the two gentlemen very well because I think he trained them. So thank you, Scott, for training them for us. But they've been really, really helpful in terms of all things related to storage, procurement of uranium. And it is it's a very different market than the other commodity markets we work with. So that technical expertise, that network of relationships and whatnot has been invaluable. The fund is very liquid, it's very easy to own, it's very easy to trade, just like any other stock. I mentioned the daily reporting of net asset value and holdings, and then finally, we think the fee is quite competitive. There's a 35 basis point management fee, and then there's operating expenses, which cover things like the storage of the uranium and whatnot. Okay, let's talk a little bit about the ATM, this at the market offering, because this is what's kind of injected new life into the uranium market. And when we announced the acquisition of UPC, one of the things that many uranium investors said to me was, we need you guys to help with the liquidity of the market and the transparency of the market and price formation and price discovery of the market. Many participants felt it was very lacking. And I can tell you firsthand that the uranium market compared to the other commodities markets we work in are very antiquated and very opaque. So that was one of our objectives, to try to do our best within the means of the trust to help improve on those dimensions. So as Gwen mentioned earlier, we've issued about $400 million in new units thus far. That's all public information. Every night we update our website. We're very active on Twitter as well. And it's all about disclosure, telling people exactly what we're doing with the trust and how it operates. Now, over that period of time, the price of uranium's gone from about $30 to today, I've seen some trades around $49. So we've had a huge move. People will say, okay, well, you guys have pushed the price up. And I guess the point here is what's happening is that investors are expressing their view. They're investing in our vehicle, and we're doing what the vehicle is intended to do, which is buy more uranium. That price discovery has led the price to go from about $30 to $50. That's the incentive price for someone to say, you can have my pounds if you're willing to pay me whatever. Here are the pounds. So I think that's been very healthy for the market to create more liquidity, more transparency. And as Gwen said earlier, the market is totally out of balance in terms of supply and demand longer term, and it needs to reset itself. So we think that the vehicle is a good mechanism to provide liquidity in the market in the spot side, and we continue to believe that that the trust will be used by more and more investors as they get more comfortable with it. You can see on the bottom of that table, it shows you the amount of pounds and the dollar value of U3O8 and UF6, and you can see there's about 28 million pounds. And just, as I said, UPC was a great vehicle in the marketplace for many, many years, from 2005 to mid 2021. It took them that long to get to 18 million pounds, and we've added 10 million additional pounds in just a month, just to give you a sense of how much more efficient this vehicle is in terms of capital raising. Okay, last slide. I'm going to leave at, if you want to learn more, we have a website that has lots of good information about the trust and the uranium market. We have a dedicated email address, and we're very active on Twitter, and you can call us anytime on a 1-800 number. And I'm going to just stop there because I know there's going to be lots of questions, and I know our other guests have lots of good information to share as well.
Thanks, John. Great introduction to the trust. Yeah, certainly lots of questions coming in. Absolutely, anybody in the audience, that we are going to do a Q&A at the end here, so use the questions part of the panel on the side there to send in your questions, and I'm going to consolidate the ones that look the same and ask them to the appropriate people at the end. But before we get to that, I wanted to also I talk a lot about how uranium equities perform so well in a uranium bull market. Well, let's hear from some uranium equities. So we have 3 on the call with us today. We're going to start with Consolidated Uranium, which is a new player in the space. You may not have heard the story before, and I'd love to ask Phil Williams to tell you what they're up to.
Thank you, Gwen, and thanks very much for giving us the opportunity. As you said, we're a new entrant to the space. We started the company about 18 months ago, with the goal, as the name says, to acquire and develop uranium projects around the globe. I think we've done a pretty good job over that period of time. We've done 6 different acquisitions, and now we have 12 projects in 4 countries around the world. So let's get into it. Okay, so here's the setup of the company. So we're an emerging new player in the uranium sector. We think we have the right strategy, of course. I think, like everybody on this panel and probably on the call, we all recognize that uranium was in a long bear market and has now emerged, and it's time to get bullish on this on the sector again. This consolidation strategy that we're deploying is not unique. It was deployed in the last bull market and generated significant returns for companies that undertook it. And I'll take you through an example of that in a second. We have what we think is the right team. The company was originally founded by the team behind NextGen and Mega Uranium, companies you may be familiar with, and a number of them remain on the team. I joined the company about 18 months ago, as I said. I've been in the uranium space since 2006. I'll touch on my background and some of the other people on the team that we brought in a second, and the right portfolio. And as we take you through it, one of the tenets of the portfolio is we put together a diversified portfolio. We're looking for projects around the world in different geographies. That's on purpose. One of the things that we've noticed in the past 10 years in the space or longer is that single project, single jurisdiction companies have often been derailed for reasons outside of management's control. And we certainly wanted to give investors insulation from that potential risk. And we've also focused exclusively on projects that have significant past expenditures, including resources in place. And all of the projects that we've acquired to date, you'll see we have historic resources in place. And importantly, in the last 2 acquisitions that we've made, which is what we're going to focus on in this presentation, we've picked up marquee projects both in Canada and in the US, where we have past producing mines now in the portfolio, positioned for a rapid restart as market conditions improve, or continue to improve, I would say. This is a company snapshot. I would only highlight a couple of things here on this slide. First, we've raised quite a bit of money over the past 18 months, over $25 million, and we still have $20 million on the balance sheet. And so we're fully funded to execute on the acquisitions that we have in front of us and development of those projects. I would also highlight we have a very good shareholder base. As part of those capital raises, we've attracted, I would say, the who's who of uranium investors. We only list a couple of them on the page there, Sachem Cove and Meg Uranium, but behind that, we've got a number of institutions, over a dozen, who have been investors in the uranium space for a long time. They've backed the company to date, and we expect them to continue to back us as we execute on this plan. Okay, so the consolidation strategy, as I said in the beginning, this is a proven strategy. And what we've done is we went back to the past bull market. So we've looked at Mega Uranium, which was one of the original consolidators of the space. And this is a chart from the beginning of 2005 to the end of 2006. And if you think back to the charts that Gwen put up earlier, uranium price peaked in 2007. But before that, Mega undertook the consolidation strategy. They did 9 acquisitions over the period in this chart, and their market cap went from $15 million to $940 million. And the share price increased 3,400%. Of course, the uranium price, as we show in the green there, was cooperating. It was moving from the 20s to the 60s, on its way to peaking at 137. But with strong tailwinds in the uranium price, the consolidation strategy generated significant returns to shareholders. And again, Gwen showed some good equity charts in her presentation. A number of other companies executed on this consolidation strategy and did very, very well, including Paladin, Energy Metals, and Uranium One. So this is the team. I myself have been in the uranium space since 2006. I've been mostly on the finance side. I've been a sell-side research analyst. I've been an investment fund manager and investment banker. And in 2017, I left that side of the business and went off with some partners and started a private uranium royalty corporation, which you're going to hear from next. But so I've spent the better part of 15 years in uranium, and I think one of the important things I bring to the table is I've been to over 100 different projects around the world, including many that we've acquired in the portfolio to date. We do have technical expertise on our team. Pete Mullins has been in the uranium space for a long time, was originally with Laramide. On the board of directors, we have guys with significant mining and financing experience. And recently, with the transaction that we announced with with Energy Fuels, Mark Chalmers is going to join the board of directors. Mark is a veteran of the uranium space and will bring a lot of market expertise to the company. And I think it's a strong endorsement of the transaction that we've announced with him. And as I mentioned, the guys behind NextGen and Mega Uranium founded the company originally, and they're still around as advisors to the board. Okay, so this is the portfolio we put together to date. As I mentioned, we're in 4 countries. So we're in Canada, the US, Australia, and Argentina. We've assembled significant resources, both uranium, but also vanadium. And that's a sort of hidden aspect to the story, which we think that is really undervalued and unknown by the investment community. We have over 225 million pounds of vanadium in our projects, and vanadium often comes together with uranium projects. We are focused 100%, of course, on uranium. And the key projects, I think, in this map that we'd highlight would be the darker green projects. So these are the portfolio projects we're acquiring from Energy Fuels in the US and the Matush Project in Quebec. And those are the projects I'm going to focus on in this presentation. So this is the portfolio that we're acquiring from Energy Fuels. We announced this transaction in July and expect to close it in the next few weeks. The key to this portfolio that we're acquiring is it includes past producing mines. So RIM, Tony M, Daneros, and Sage were all past producing, and the permits remain in good standing. And importantly, they're proximal to the Energy Fuels White Mesa mill. This is the real key to the transaction. These are conventional mines, and in order to have a pathway to production, you need to have access to a mill. And as part of the agreement with Energy Fuels, we have a toll milling agreement, and we're the only junior company that has that toll milling agreement in place. And quite frankly, we're the only company other than Energy Fuels that has guaranteed access to the mill. So that's an important consideration. And these mines, as it shows on the slides, they were in production in that past bull market. So 2013 for Daneros, 2009 for RIM, and 2008 for Tony M. And they've been kept in good standing. As I mentioned, the permits are still in place. And so we really think we have a rapid pathway to restart these mines, again, as uranium price continues to move and make them economic again. And with the toll milling agreement, we think we can be in production very, very quickly, producing material as fast as almost anybody else in the space. The strategic alliance with Energy Fuels is critical. And as addition to the toll milling agreement, we also have an operating agreement where they'll continue to operate the projects on our behalf. And we have an investor rights agreement. We show the details of the transaction there. As part of the closing, they will become a 19.9% shareholder in the company. And there's certain rights that come along with that. The second key project in the portfolio is Matush. We closed this acquisition in August. This is an extremely high grade resource. At its indicated grade at 0.95% uranium, ranks it as the second highest grade project in the world outside of the Athabasca Basin. We believe there's significant exploration potential here. We bought this project out of bankruptcy for about $10 million. Historically, there was over $100 million spent on it, and the company that owned it had a market cap well in excess of that in the past bull market. We think there's an opportunity for us to unlock significant value here, both by moving the project forward and potentially expanding the resource, which has potential along strike in the tens of kilometers. So where all this ranks us, we've taken a sort of very general approach to valuation here, and we've shown where we rank on an EV per pound. So these are taking our enterprise value, dividing it by the pounds, and taking our peer group and doing the same. So we're at the low end of the range, both when you just look at our uranium, which is the green bar, and when you also add the vanadium that we have. And we think there's a real opportunity for us to move in line with our peers. And it's a function of being a new story and the market not knowing exactly what we have or how to properly value it. So I would just go through the catalysts for the company. We're going to close the Energy Fuels transaction shortly, and we'll make we'll put out some news about how we plan to move those projects ahead. The key to unlocking Matush is engaging with local stakeholders. That will be another catalyst for the company. And we have a number of other projects which we don't talk about in this presentation, and we'll exercise and close those options. And we're not done. We have lots of other work that we want to do in the M&A space, and so we'll continue to evaluate additional opportunities. So in summary, we have an attractive portfolio of projects in good jurisdictions. We have near-term production potential. We're very busy looking at new opportunities. We think we have a compelling valuation. We're well funded with over $20 million in working capital, and we have a team with a track record both in uranium, but also in M&A and mining finance.
Well done, Phil. Everybody should get a prize. Everybody who stays in 10 minutes gets a prize. I don't know what the prize is yet, but I'll figure something out. Thanks, Phil. Thanks for the introduction to Consolidated. A newer, like you say, entrant to the space, so lots of people perhaps haven't heard about Consolidated. I have some questions for Phil that I jotted down during his presentation. Please, anybody in the audience, if you have questions for Phil, then send them in through the question part of the control panel on the side. And moving right along, Scott, I would love to ask Scott Melby to take us through the uranium royalty story. Like I say, I have three very different uranium companies on the panel today, and Scott's got the uranium angle. So go ahead, please.
Great, thank you, Gwen, and it's great to be with you. Yeah, the Uranium Royalty Corp story is quite a young company and a relatively new story. And in fact, we Okay, so we, the co-founders of Uranium Royalty Corp about 4 or 5 years ago really came together and looked out at what had been happening in the base and precious metals industry for some time. A $50 billion industry that had emerged in the last 10 to 15 years. Companies like Franco-Nevada, Wheaton Precious Metals, Sandstorm, Royal Gold. And basically, they took the model of not owning the mines, operating the mines, having the landholding costs, standby costs, but instead just investing in financial interests in those mines and developments, ultimately producing either through a royalty, a financial interest in that production, or in a stream, in a physical uranium interest in ultimate production. So we took that concept to the uranium industry, and to this day are the first mover in the space, and it's very timely given, I think, the cycle that's about to begin here in terms of uranium investment and new developments that are needed to close that production consumption gap. But we have a very strong balance sheet as we sit today, 85 million in cash, equitable security, marketable securities and physical holdings. I'll get into the physical uranium ownership, which is through our Yellowcake equity holdings and physical uranium. We sit today with a very large portfolio for a relatively young company, 16 royalties in the portfolio to date, and we bring expertise in the uranium space. We are uranium people. We've spent our careers in nuclear energy and uranium, and intend to focus all of our energy on uranium royalties and streams. The management and board, one of the advantages of a royalty and streaming company is we can have 4 or 5 full-time employees and double, triple the size of the company because we aren't the operators. But what we do that is important is that we understand the uranium markets and we understand the projects that we're investing in. So due diligence is an important part of what we do. We have folks like Darcy Hirschhorn with over 20 years of experience as a global Expiration for Chemical Corporation, myself with 37 years and with 3 of the 4 largest uranium producers in the world, but also every aspect of trading, procurement of uranium, and working with Uranium Energy Corp and Uranium Royalty today. We have a very knowledgeable board that brings years and decades of experience in financial markets and uranium mining. So as we sit today, for a company that only launched on the TSX just almost 2 years ago now and listed on the NASDAQ earlier this year, our Canadian dollar market cap was approaching $500 million over the last week. So we've come a long ways in a very short period of time. You see some of the key shareholders there. Certainly some of the foundational corporate shareholders like Uranium Energy Corp remains the largest shareholder at 18%. But companies like Mega, Altius that vended in either projects or management as sweat equity, as Phil mentioned, served as the first CEO of our company and really got the company up and started, was our first employee back when we literally, before we even had letterhead. So we've come a long ways from 4 or 5 years ago to public listing and now up and running. But you see some of the big names in mining and finance, and Rick Rule, Marion Katusa, Darren Millmeister, Warren Gilman. These are big mining investment names that really love the royalty structure and eager to see it deployed in uranium. So like any royalty company, we want to be diversified in every sense of the word. So we're going to be present in every major uranium producing district in the world, various sizes of counterparties, various stages of development, near, medium, and long term, investing across the cost curve, and again with that physical ownership providing near-term exposure. To date, many of the acquisitions have been in the secondary market, if you will, acquiring existing royalties that have been in place, either landowners or remnants of M&A activity. But we've gone and out and acquired royalties like we've done with Rough Rider and Cigar and Macarthur. The next wave for us is really to become a project financer, to provide an alternative to debt and equity for mine developers and operators, to provide that $30, $40, $50 million to get a well field constructed, a processing plant built, or get into production or advance towards production. And obviously we'll target our offerings in royalty and streams to be competitive with what developers are facing in the debt and equity markets. We are different from, I would say, just a financial institution or an uncaring bank. We get the uranium industry, we get the challenges, the risks and opportunities that are presented in our unique and sometimes peculiar industry and commodity. But it's not unusual for me to go and spend the entire day in Australia with the board and management of one of our counterparties and go through restart considerations, marketing considerations. We can provide our decades of experience and share that with our counterparties because their success is our success. We also expand the capital markets presence of these companies. When we go out and talk about uranium royalty, we're really talking about their companies. It also provides a bit of an endorsement in sense of who we look at the whole counterparty universe and whom we choose to invest in. Again, we're only as good as those counterparties that we align with, and pretty impressive for a young company, some of the largest mining companies in the world, Cameco, Orano, Rio Tinto, also some of the largest consumers in the world, EDF and CNNC out of China, and of course, some of the more entrepreneurial junior companies that we're quite pleased to be aligned with. To date, we're focused in the United States, both conventional and ISR. We're in the Saskatchewan Athabasca Basin and in Eastern Canada. We have interest in Namibia through Langer Heinrich and exposure into Kazakhstan through our Yellowcake investment. Obviously, we really put ourselves on the board with the Macarthur and Cigar Lake acquisitions earlier this year. I'll get into them in more detail. Obviously, they're good examples of nearer-term cash-flowing royalties that can provide revenue in this cycle that we're embarking on. Rough Rider is a great example of a longer-dated royalty where it may not produce and cash flow in this cycle, but is a very likely candidate for a future mine as some of the current operations in the basin either phase out or shut in or exhausted, and Rough Rider's proximity to the McLean Lake mill is quite attractive. The Macarthur River royalty is quite straightforward. It's 1% on revenue. It has the unique feature that it can be converted to a physical uranium payout rather than a percentage of revenue. And the previous royalty owner, Reserve Oil and Minerals, exercised that right back in the last bull market and was able to realize over $100 a pound on their small portion of output from this very important mine. I mean, the world's largest, highest grade operation, world-class in every sense of the word. So we're quite pleased to be involved with Macarthur, Orano, and Cameco in this regard. It has been a steady cash flower and will as soon as that mine restarts from kind of voluntary shutdown due to the market conditions that have prevailed over recent years. The Cigar Lake royalty is a net profit interest, so it has a few more moving parts to it. So we are still in a phase where we're working down on the expense bucket, if you will, before we start to cash flow under this. But ultimately, at steady state, when that happens, this will be a bigger royalty than the Macarthur River. Combined, the two in a $50 market, $50 market, we can see at steady state production probably $5 million revenue once these mines are fully up and running. We have expiration royalties. Again, I won't go into detail. The value of these will be dependent on exploration success and activities on these projects in the basin. We've spoken a bit about physical uranium exposure. We were one of the foundational shareholders in the Yellowcake PLC founding on the London Stock Exchange a couple of years ago. We did this to provide our early shareholders exposure to uranium at near market cycle lows, and in taking a just under 10% interest in Yellowcake, gave us that exposure. It also gave us rights to purchase uranium from Kazatomprom through their long-term agreement, which we did earlier this year, buying 350,000 pounds at under $29 a pound. We've increased our physical holdings through open market purchases. I think recently we announced we purchased 300,000 pounds from the spot market. It increases our inventory to about 650,000 pounds at a weighted average cost of $33.10. So the investment gain to date would be around $10.9 million at $50 a pound, and that's all stored at the Cameco facility in Ontario. We're very high on ISR coming from the UEC school. We believe ISR in the United States, it's permitted, licensed, can be some of the lowest and most scalable production in the world today. So it's no secret we're interested in these projects having existing royalties, and we would look to do more in this space. Conventional royalties, Langer Heinrich is a project that we really like. It's a project that has also been shut into the low uranium market prices, but they've gone through extensive cost efficiency exercises to lower the production costs, and with some investment, restart that mine. And we'll look forward to the royalties restarting on that project. Michelin obviously has an enormous 100 million pound resource in eastern Canada. And in the US, conventional has very unique economics from the ISR in the US, but as Phil mentioned, really benefits from vanadium rare earth minerals and that milling capacity that Energy Fuels controls in the Colorado Plateau. So in summary, I want to keep under 10 minutes here. URC has really provided a new source of royalty and streaming finance for project miners and developers in the space, which is very important in this cycle that may need $2-3 billion worth of mine development capital expended to get the next wave of mines up and running. But for investors, really provides a nice diversified pure play exposure to the uranium story. Again, you're not relying on one mine and its prospects. Your risk is spread out. We're going to have royalties in the portfolio. Some exceed expectations and some underperform. But if we're doing our homework, we're doing the due diligence, we'll have a portfolio that performs very well going forward. And it really is a growth platform. What you see in the current portfolio is just the beginning, and we're very actively looking to expand and grow the company. With that, I will turn it back over to Gwen.
Thanks, Scott. Yeah, great presentation. Great to understand the royalty angle. Questions have come in for Scott for sure. Please keep sending those questions in. Some of them, of course, Scott, for you are just about uranium, not about uranium royalty, because turns out people know that Scott knows his stuff. I love the connection between the first speakers here, like John credited Scott for training some of his guys. Scott credited Phil for starting the company that he's now the head of. It's, you know, it takes a village. And then we have Jim, haha, which I say because I invited him specifically for that reason. Valour is not known first for its uranium asset, but Jim has carefully held on to the uranium asset that this company was focused on years ago because he saw opportunity in uranium down the road and knew that it could well turn into potential for his investors. So Jim, with that introduction, please tell us the Valour uranium story.
First of all, I want to thank Gwen for organizing this, and I recently accused Gwen of being incredibly hardworking, conscientious, and super professional, and my feeling towards Gwen stands. I want to thank her for bringing forth this panel. I don't know John, but Sprott's strategy and structure has done an amazing turned the industry around recently, and I think we were talking earlier, it isn't the reason it turned around, but it was an amazing catalyst. It's opened the floodgates and has added so much value to all the juniors and the developers out there. So we thank John and Sprott for that. And then to compliment Scott, he is without a doubt the most knowledgeable person that I know in the uranium sector, and is an amazing resource. We're happy to have him here. And I can't leave this without complimenting world's greatest deal maker, Phil Williams. I've known Phil for a long time, and his shareholders really benefited the last uranium bull cycle, and they took advantage of it. So the guests are amazing, and I'm humbled to be a part of this group. So without further ado, I'll move on. My name is Jim Paterson. I'm the chairman and CEO of Valour Metals Corp. I have pressed advanced. I'm not sure. So who we are, Valour Metals is part of Discovery Group, which is a mining house in Vancouver, British Columbia, led by John Robbins. We've got 10 public companies in the group. You may recognize some of these logos, but really we're a group that has a great reputation for great deal flow, excellent success, really based upon the high quality and caliber of the people that work in the group. So all the companies are separately managed. Valor has its own board of directors, management team, and we just benefit from being part of the group, the economies of scale, the credibility, the deal flow, and the access to people and capital. A little bit about the company, under 50 million market cap. I think we're at 39. That's almost accurate. This was done a couple of days ago, but it still rings true. Over 20% ownership. When we talk about 20% insider ownership, and then we're supported by some really great funds. And then we have a really big retail following as well. In terms of the board of directors, specifically, there's very relevant experience in the uranium sector. Jim Malone was the chairman of Hathor. You can see that little logo in the bottom right-hand corner of the slide. And Dale Walster was behind the company that rolled the asset into the shell called Hathor. And then he was part of the discovery team that made the discovery of the Rough Rider asset. And for that asset, Rio Tinto bought Hathor for in excess of $650 million. So these guys have certainly had some great exploration and M&A success in the uranium sector. And then we've got some great board members that have legal, geological, M&A, project management success, as well as our management team. You can see some of the deals that some of the members have been a part of on the team, but you know, we are a group that's known for exploration success and M&A success. Once we get the project to a certain stage, we look for buyers to take it forward. Before we get into the uranium side, because I'm going to talk about comps and valuations, and I'll force everybody to hear this story because Gwen was right. This company used to be called Kivalliq Energy Corp. We advanced the Angalac project to a certain stage, and then the uranium sector black swanned us. We had several years of drought, and we decided to go out and acquire other assets that were in different commodities until the uranium market turned around. So we have acquired a project in northeastern Brazil. Over $30 million US was spent by previous operators. Valor has spent over $5 million. We have a resource of over 1 million ounces of PGM or PGE, palladium and platinum. Excellent location, near surface, high grade mineralization, and we think there's lots of exploration upside. So when you're looking at comps, this project sits right in the middle of that and is not really counted in this recent uranium boom. So now we'll move to Angalac. Can everybody see my cursor? Hand moving around there. That's where the project is located. You see the red star in Nunavut territory. We've got about 50,000 acres. It's highlighted with these blue boxes, and it really hugs the northern boundary of this subbasin to the Athabasca. It's the Anjikuni subbasin, and this is a basin like the Athabasca or the Yathkit up here. We have spent over $55 million in this project. Much of that, let's say 90,000 meters of drilling, about 60,000 meters was spent or focused in this area, where we've outlined a little over 43 million pounds of 0.69% U3O8. There's lots of upside. These orange squiggles here represent the 5 zones that make up those 43 million pounds. I'm going to just take you from those orange squiggles to a different representation. There's the orange squiggles. You can see the WE, the MZ. So this is the western extension, the main zone, the eastern extension, J4 and Ray. So these 5 zones make up the 43 million pounds. All of them start at surface or very near surface. We haven't yet determined at what depth they subside. That's really more of an academic. We were looking for near surface pounds in the ground, and so we marched along these structures and drilled down to a few hundred meters, but most of this stuff is all near surface. Over 335 drill holes, 0.2 cutoff, and we've had real success. The first Inferred Resource came out. Then the next year we discovered the western extension and the eastern extension. The following year we discovered the J4 and the Ray, and we were able to incorporate all of those into the Inferred Resource that we have right now, which is 43 million pounds. You know, unlike many companies out there, and I'll show you a comp slide, we actually have an Inferred Resource, but we've done metallurgy as well. And we had a guy named Chuck Edwards that did that work, and he's effectively worked at every mill that's operating in Canada, all the different uranium mines in Canada. And his characterization of our ore was it's a highly attractive yellow cake product, and the metallurgy was very successful. This just kind of shows that one area we call the Lac50 Trend. So It's about 3 kilometers by about 15 here. And we're just showing you the different methodology that we use to make these discoveries and add them to the resources. So firstly, we use just old school geophysics, which kind of identifies the structure. Here's a different representation over it here. It doesn't see the mineralization, but it sees the structure here, these tooth units, and they're the ones that typically will host the uranium. And these areas, these are volcanic areas, these are basalts, and they don't light up with the geophysics, so they don't have these magenta colors and are not prospective generally. Once we've identified those, we will run soil lines over them, and if they're juiced, we'll drill them. And so we've had quite a bit of success, particularly in this area. This area is kind of a blowout of these little orange squiggles I showed you before. These 5 zones that are represented by these purple blobs are on one structure, and they represent about 43 million pounds. And then you'll note these other areas that we've drilled off that are parallel, that are discrete structures from the ones that host the Inferred Resource. We made about 700 discoveries. We've drilled them, and they are mineralized, in many cases look identical to the zones that host the resource. So there's huge upside even in this area. So that, here's your, the 5 zones. They're represented by these 2 big red stars. And then all these other red stars are ones we've drilled. So these aren't just like a rock sample or a soil sample. We've actually drilled these things off. They're mineralized. They look like the resource areas. And it extends over 30 kilometers all the way over here to the dipole and the rip. So the entire area is completely juiced. And what we're working on right now, Gwen kind of asked to see, like, what's the plan, the next 4 months, the next year and a half. Excuse me. So we're really working on leveraging the $55 million we spent with all the drilling. So we're doing geochem, geophysics, reprocessing, and then we're doing some really high-end hyperspectral or satellite imagery. We're going to take all that together, and what we hope to do by October is really highlight how this thing is not 43 million pounds, but this substantial exploration upside property-wide, and really kind of set us apart as the foundational asset and the resource, but just as much, if not more, exploration upside to other of our competitors or peers. So, and then this final slide is just kind of to show the relative valuations. These are developers. A lot of these companies are moving, have been a lot more active over the last few years. So it's no wonder that they are valued much higher on a per pound basis. But if you look at the explorers out there, here's a big broad cross section of the Canadian uranium explorers, and you'll note that really only one of them has a resource, and the other ones do not. So it doesn't mean they haven't drilled off a lot of uranium and won't have a resource in the near term, but as it stands right now, they don't. And I think that as an explorer, we should say that just because you're drilling doesn't mean you'll find uranium, and just because you find uranium doesn't mean you'll add it to your resource. So there's a lot of failure that goes along with it. So we've kind of gone through the hard yards in the last cycle. We put about 43 million pounds on the board. There's a lot more to come. We've done a lot of metallurgy. So I think as we sort of get out there and market ourselves again, it's been about 10 years that we haven't. We're going to start to get some traction in the marketplace and get us a little closer to the valuations of some of our competitors. So lots of drill results to come from our palladium project. We're very excited about that. And then as far as the Angelac uranium project in Northern Canada, which I was just showing you, October we'll have a lot of information that we'll be able to present. And then we'll be able to actually put forth a plan that we hope to unlock a lot of value for the shareholders of Valour based upon the asset, whether that's a financing or a spin out. The board will approve it at the time, and we'll kind of be discussing with different financiers and potential partners what the best strategy might be, but we're getting a lot of interest.
Thanks, Jim. I'm sure you are, and some of that interest obviously from attendees on this call, which is why it was so great to have you. So we've already been going for an hour. I don't want this to go on too much longer, but there have been a lot of questions. So what I'm going to do is ask each participant 2 or 3 questions, and I want each of you to answer as succinctly as possible. I know that's tough because there's a lot of information that you're trying to convey, but nonetheless, let's do that. So John, let's rotate back to you. Can you talk about the relationship between spot and the uranium price. So first of all, do you have a target, or is that based solely on investor inflows? Secondly, when the price goes down, or how do you handle redemptions? Do you have to, how does a sliding uranium price relate to your actions in the market? Can you just describe that relationship and intent? I think you're still muted there, John.
There we go. I was unmuted by the organizer. There's a lot of questions there. Well, listen, we don't have any set price target for uranium, other than we're bullish on it like everyone else, because we think long term it needs to find its place. That's going to incent pounds to come out of the ground and meet the long term requirements of a growing fleet of reactors. So that's our big picture. So we're not managing the trust to any kind of targets. The trust is passive in its operation. We don't make market timing calls. We have the flexibility to issue new shares. It's totally under our control, and we will only do so when we can do that on an accretive basis, and that's a key element to us. The other thing is important is we need to have line of sight on the material, meaning we don't necessarily want to issue new shares and have the cash just kind of build up. We can hold cash in the fund up to 10%. But again, our goal is to provide that exposure to the spot market by buying more pounds and filling up the trust. So that's the broad strokes plan. The other thing we don't do is we don't lend any material. That is one thing that's been kind of swirling around in the marketplace recently. Will you guys do that, given you guys are, we're now, the trust is sitting on 28 million pounds? The answer is no. We have never lent any material on any of our trusts since going back to the inception of the very first one in 2010. It's something we're, philosophically, we're not really too interested in doing it. It does involve counterparty risk, and it's just, I'd rather have my hands on the pounds at all times.
Is there a part of the trust structure that would require you to sell uranium based on price movements or investor interest? Does that structure exist?
Right. So at this time, there's no redemption mechanism in the trust, either physical or cash, and that's important to understand. The only reason we would ever need to sell any uranium is to raise cash to pay for the operating expenses of the trust, and that's easily avoidable by just holding a little bit of cash. And you can look at our website every night and see that, generally we hold 1 to 2% cash on average, and that's more than enough. So we don't anticipate having to sell any pounds. I'm often asked, will you guys sell uranium and take the cash and buy units if the units trade at a discount to net asset value? And I've consistently said no. I don't think that's a winning strategy for the fund. I don't think it has a lasting or material impact, and all you do is shrink your fund at a time when the market's already under pressure, and you end up exacerbating the market situation. So it's not something we've ever done for any of our funds. And again, a lot of this is in the playbooks of all of our other funds. We don't tend to do this stuff. We let the market kind of find its own natural setting. We know that parties will come in and buy the shares when they're trading cheaply relative to their net asset value, and we just let the market give it time to sort itself out.
Good capture. I'm glad you commented on whether you're going to lease pounds, because I got lots of questions on exactly that, so I don't need to ask that anymore. I guess the only other thing I'll ask is there's been a bunch of questions on sort of how you physically execute the transactions to buy uranium, sort of timeframes to delivery, and can you negotiate, and how that works.
Well, that's been pretty fascinating for me as someone that's not been familiar with the process up until the last couple of months. I think we've made transactions with 15 different counterparties so far, which is really interesting. We're really casting a wide net in terms of where to find those pounds. We've bought material from the obvious suspects being traders. We've bought from producers. We've bought some from investment funds. We even bought some material from a junior uranium company who sold us a little bit. So we're casting a wide net. It is a very different process than buying other things. It's a lot slower. You're dealing with people at the other side of the world. So sometimes I want to buy something and I'm told everybody's sleeping there, so they'll tell you in the morning. So it's, there are some nuances to trading this market relative to precious metals, which, trade 23 out of 24 hours a day. But we've got this great technical advisor, WMC Energy, which I referenced before, and they've just been fantastic in terms of helping us wade through all those nuances.
Gotcha. Fantastic. Thanks. I could keep pestering you, but I'm going to move on in the interest of time. Phil, you obviously spent a lot of time looking at, global uranium assets. So I'm sure you have ideas around relative, which ones are more attractive and which ones are less. There's been quite a few people asking about US uranium projects versus those in the rest of the world. Do you want to talk about that? Whether you think there's a premium, whether you think they're more in demand, either on the project side or on the pounds of production side?
Yeah, there's definitely a premium for US assets. Am I on mute?
No, you're good.
Okay, there's definitely a premium for US pounds. I think that's why the Energy Fuels transaction for us is such a transformational acquisition, and I think that we think those pounds should get that premium. Generally, recently all pounds are getting a premium, and so prices for new acquisitions that we're looking at have increased across the board, and the value of the things that we've already acquired have increased. I think for us to do more acquisitions, we need to see, the relative strength of our currency improve vis-a-vis the rest of the group. And in that comps table that we put together and showed kind of highlights how we've got some work to do to get back into line with our peers before we might go do some other things. But we've got a full pipeline of opportunities that we're reviewing.
Sort of an add-on to that question, I feel like your business plan has changed, whether you like it or not, even in the last month, right? Since the uranium market basically took off, the ground is shifting under your feet. Do you inherently like optionality, right? The concept of building pounds. Do you prefer adding value to the assets that you have? Do you think that there's a happy medium for Consolidated Uranium to do both?
Yeah, you're 100% right. So a month ago or 3 months ago, our business plan was to acquire these projects and do nothing with them and wait for the uranium market to catch up, and then look at moving the projects ahead. That's changed. And I do think that in several of our projects, there's some very low-hanging fruit in terms of work that we can do for very limited amount of money that we have on the balance sheet, that we can add value there. So I think the pendulum's swinging a bit more that way, but I do think there's still opportunities out there for us to accretively add resources, and particularly complementary resources where we already have a beachhead in a jurisdiction, and particularly with our toll milling agreement and a relationship with Energy Fuels, there might be some assets that fit well with what we have versus standing alone wherever they might be.
Fair enough. I'm going to ask you a question that's about uranium in general instead of specifically about your company. Can you talk about how the uranium spot price is officially determined, and whether you think that there were several people asking about whether uranium can be manipulated the way that gold and silver are perceived to be?
That's really a question for Scott. I think I wouldn't want to take that away from him. That's right up his alley.
All right,
Okay.
then I will shift directly to Scott. Scott, how is the spot price determined? Yeah, let's start with that.
How's the spot price determined in our industry versus other commodities? It is quite unique in that regard, and I think the entrance, frankly, of Sprott is helping, I think, correct some of the dysfunctions that we've seen in the uranium spot market. It doesn't trade as liquid or high volumes as, say, silver, copper, or gold. And that sometimes creates problems when it's very, market volumes are very light. It gives the opportunity for, a little bit of supply or a little bit of demand to have an undue influence on the spot price. And the solution to that is not regulation or anything else. It's just increased liquidity. More players in the spot market is a healthy thing. Both to the upside and the downside. We just want an accurate price for uranium, which reflects cost of production, demand for uranium globally, and I think we're moving in that direction. So we're kind of an inefficient, immature market in many ways, but we're growing up in a hurry. We're seeing that happen.
You mentioned new liquidity available in the market. That's there's more people buying and selling, and there's also just more investor liquidity. There's more ways for that to exist. Do you have what do you think for engaged investors? What do you think is the best way to measure the money that's going in or out of the space on a monthly basis or a weekly basis or something? Like, how can people capture what's going on with uranium?
Well, I don't know if it's a hard data metric, but we're just certainly, there's always been the uranium bulls and the funds that have focused on uranium and nuclear for some time, but we're just seeing such a huge inflow of retail interest, generalist, and also institutional generalist interest. And again, the number of phone calls we get from folks all over the world asking, hey, give me the uranium 101. Tell me about nuclear energy. How does it fit in the mix today? And I quite enjoy those calls because these are investors coming in either for the first time or they haven't been invested in our market since the last bull market. And they're coming back, and they're coming back in a big way. If you want a hard data measurement, just look at the trading volumes of Uranium Equities. UEC trading 5, 6, 7, 8 million shares a day, across the board. It goes back to what you said earlier. There's very few doors for this capital to flow through when interest returns to our sector. So you see the trading volumes across the board pick up pretty dramatically.
Okay. I could keep asking you questions for ages. That's generally my position with Scott. I could just ask him questions all day, but I'm going to have to limit myself. I'll do one more. Let's talk about contracting. I mean, like, the game here is to dry up the spot market, to force utilities to sign contracts, and then to see what that does to the big picture. What comments do you have on that? What are you hearing? What are you seeing? What prices do you think that they're looking for? Are they just waiting for the other guy to act?
Yeah, well, and you showed that slide earlier, and it is the next shoe to drop because we have seen utilities contract at below normal levels, below 75 million pounds for the last 8 years. They should be contracting at 175 or 180 million pounds in a normal year to stay ahead of their future requirements. And those uncommitted needs are growing quite rapidly. So, just as that shoe was to drop and utilities were beginning to think more about contracting long-term, we see the uranium price take off. So now utilities are very interested in long-term contracting and hedging their upside exposure. Well, something funny happens on the other side. Producers are going, hey, wait a minute. I've been suffering at below production costs for a decade. No, I'm not so interested in capping my upside, and maybe are more interested in market-related contracts. But in terms, of the base escalated market price, I think we'll see that price discovery in the coming months, and we shouldn't be surprised. I mean, listen, no one knows more than me, having sat at the helm of Cameco's marketing. I signed legacy contracts in the 2004-05 time frame, which I never want to do again. I learned a valuable lesson. But I've also learned that at the top of the market, those contracts we locked in, sustained Cameco for many, many years. So I think, producers and utilities are just going to kind of soul searching right now as to what to do to position themselves in a uranium market, which has been basically going nowhere for years at a time. But, the long-term contracting that will ensue in the coming months now, I think it's a positive thing. It doesn't have to be negative for the utilities. I think the Sprott entrance, if it's been the tipping point to get prices back up to a more healthy level, you're going to see contracting with producers and create a more diverse long-term market for utilities. They're going to have a more widespread source of miners to contract for their, it's been fun to contract with traders under carry trades and get very low prices for a long time, but $20, $30 uranium was not sustainable, and it was good to lower the fuel costs, but probably important to look more strategically going forward now.
Now you've all gotten a sense of how long one can chat with Scott about uranium. I will have to cut him off there so that we're not on the line for too long here. And I certainly have several questions in for Jim. Jim, you mentioned some of the things that you might do to crystallize value in this asset. I've gotten a bunch of questions seeking some more insight into your line of thinking there. And I know these are things that the board has to approve and whatnot, but what sort of time, do you want to do a season of work before you decide on a spin out? Do you want to, are you getting, I'm sure there's parties banging down your door that would love to buy this asset right now. Can you just, I don't know, put a bit more color and maybe some timeline thinking around what you might do with this asset?
Well, firstly, we can't do anything like that until we have a news release. So what I've told people is that we're going to deliver a bunch of information that will, we think, add value to the project in the next couple of weeks. So hopefully people will be able to wait that long. But I will tell you that I participated in the very short bull run that happened in 2010. And, the wind was cut out of our sails early on in 2011. So I guess my answer is no, I won't wait to try to do something of significance for over a year and a half. Mostly because I've been stung by the uranium markets before. I think I think that the board and management team of Valour is quite commercial, and definitely part of the discovery group. We're quite commercial. So, my focus, if we're not going to fund it ourselves and advance the project next year, which could be a real possibility, would be to partner with a group that would protect our reputation in the territory of Nunavut, provide superior technical capacity from a geological and exploration perspective, be better promoters than we are, have more experience in the capital markets, and be stronger M&A people. And I think those groups are definitely out there. And so it's just a matter of us getting to a point where we can properly convey the value of our project, which will be in the next couple of weeks to a month, as I said. And then, the conversations are already happening and the phone calls and emails already being logged in.
Okay, gotcha. There's quite a few people on the call who know your company well, and they're asking about your other uranium targets, projects, things that you didn't mention.
Mm-hmm.
Do you want to describe those briefly?
Yeah, we do have sort of two project groups in the province of Saskatchewan. One's called Genesis, which we're partnered with a company called Rough Rider Expiration, and the other one is called Hatchet, and that's sort of a little closer to the basin. Those projects we've been really inactive for the last couple of years, and in particular the Genesis project, we really lost a lot of our mineral tenure, but the Hatchet remains intact and is actually in quite a bit of demand right now. So we're having lots of conversations on that one, and we'd be happy to talk to anybody on that project. We didn't do that much work on it. We didn't, spend $55 million on it, but we think it's strategically located, and we'd like to. We're open to deals for sure, but not with Phil.
But not with Phil.
I'm just joking, Phil.
We don't buy exploration properties.
Oh, okay.
Resources only, Jim.
Okay, good. We don't have to negotiate then.
I could honestly keep going with questions for another hour. I have that many more questions. I tried to consolidate some and ask the ones that had been asked the most often. But we've been online for almost an hour and a half, and I don't want to take any more of anyone's time, those who are watching and those who were kind enough to participate. So I'm going to wrap it up here. Everyone on this call can be reached. I mean, John showed how there's an email address for Sprott. I mean, Scott, Phil, and Jim, you can find them on their websites, whether they like it or not. And same with me. So please, if you have more questions, please feel free to send them to us. Perhaps I will even try and get some of these answers done and do another video myself that conveys some of the answers to the questions that I didn't get to, and I can solicit those answers from these gentlemen in the next day or two. So I'll try and answer the questions that didn't happen in that way. But with that, thank you so much to those who were watching. We really appreciate your time today and your interest in uranium. And certainly thanks to John, Scott, and Phil, and Jim for participating today. It was a really fantastic panel. I had a good time. I hope everyone else did too. And with that, everyone, have a lovely day.
Thank you, everyone.
Thank you, Gwen.
Thanks so much. That was
All right,
awesome.
take care.
I know.